When I'm assisting clients with inheritance tax planning, one of the things that we look at is gifting assets during their lifetime. The reason that we do this is because we would be able to reduce the total value of their estate on death and reduce their exposure to inheritance tax at 40%. Two of the ways that we can do lifetime gifting is through either a potentially exempt transfer, a PET, or a chargeable lifetime transfer, a CLT. A PET is an outright gift of an asset from one individual to another individual, and a CLT is a gift of an asset to a trust. So what are the benefits of a PET? As already mentioned, it removes the asset from the individual's estate, reducing the amount taxable at 40% on death. If the asset generates income, this could be paid to a recipient who may pay income tax at lower rates of tax. Many people have heard of the 7-year rule when it comes to pets. So if the donor passes away within 7 years of making the gift, the asset is still chargeable within their death estate. This should be taken into consideration. However, a pet is frozen at the market value at the date of the gift. So if the asset is going to grow in value, that value isn't going to be subject to IHT. Also, taper relief is available. So after 3 years has passed, the potential IHT payable is abated down. Things that we need to think about with pets is that if the donor is intending on retaining any kind of benefit in the asset, then HMRC could impose anti-avoidance legislation. Also, gifts can trigger other tax charges such as capital gains tax or stamp duty land tax, so your tax advisor will be able to consider these and also utilise any available exemptions and reliefs. It's also important to remember that an outright gift is just that. You are giving away the asset and you are losing control over it. Moving towards the benefits of a CLT, these are only subject to tax on the initial transfer if the value exceeds £325,000, the nil rate band. As this nil rate band refreshes every 7 years, it is possible to create a new trust without any immediate IHT charges every 7 years. As mentioned previously, an individual's estate is reduced and therefore reduces the exposure to IHT at 40% on death. And trusts offer a level of protection that outright gifts don't do. So if you want to give your asset away in a way where an individual can benefit from the income, but there's still a level of protection around the asset, a trust might be a useful tool to do this. Things that we need to bear in mind when doing a CLT that creates a new trust, again, it relates to whether the donor intends to retain any kind of benefit in the trust assets, as HMRC could impose anti-avoidance legislation. Trusts do have ongoing compliance and filing obligations, so costs will be incurred for legal and professional fees. And there are potentially ongoing IHT charges. However, these are capped at 6%.